welcome. This is AMA session 29. Today I have Jeet Shah with me. Welcome, Jeet.
Thank you.
So, Jeet works in equity research, but I'll let you introduce yourself. If you can do a quick intro of what you do.
Okay. So, I'm a senior equity research analyst at Moneyworks for Me. We are a SEBI-registered investment advisory out here in Pune. The firm was started in 2008-9 when the gap was identified by the founder that there is very less institutional quality research available to retail and HNI clients. So currently we have more than 300 plus clients, and asset under advisory is more than 400 crores. So that's what we do. We are the fiduciary investment advisory who are out there. So we will get the most unbiased research and recommendations from us.
Okay.
Yeah.
Fantastic. So, Jeet, let's kind of dive deep a little bit into different SEBI options which are available.
Right.
So, you said you're SEBI-registered investment advisor.
RIA.
That's called RIA.
Yes.
Right. So, under SEBI, if I have to set up a business, one is I can do a fund. So, that becomes either a mutual fund
or an
AIF, or I can be
PMS.
a PMS. Right? That's one option. But then there is also this thing called RIA versus RA versus mutual fund distributor.
Right.
Can you clarify for the benefit of audience ki hota kya hai?
Yeah. So let's start from a investor's point of view. So either you can do direct equities. For direct equities, you will need to do the research yourself, and you will need to even kind of understand how to manage a fund yourself. So that is one option, which for most people it doesn't work because you have a job, you have a business to run, so you can't do that yourself. So then all these products came into being. We have mutual funds which work for most people, but choosing a mutual fund which is right for you, and if you need customized advice, it doesn't do the work perfectly. So then after mutual fund, options which you have are PMS and AIF, which start with PMS, the minimum you have to invest at one time is 50 lakhs, and AIF, which is 1 crore. So these are meant for people who are looking for the risk appetite or the needs are different.
Understood. So, sorry, I'm going to cut you in between. So, if I'm an investor,
right,
I don't want to do my own stock picking.
Perfect. Yeah.
So, I need some fund manager to invest on behalf of me. So, I have three options.
Right.
I can either do a mutual fund, PMS, or AIF. So, one main difference is the ticket size. In India, AIF, you need about 1 crore rupees. PMS, you need 50 lakhs. Is there a key criteria of how investors should choose one of the three?
Right. So, I think first let me tell about RIA, and then we can go towards because we'll know where the placement of the product is from you. So if I'm looking for a thing wherein I want to not give performance based fees, which is there in PMS or AIF, most of them have performance based fees, and I want to customize advice also. So I want to partner with you. I want to understand what you are recommending from a research or a studied perspective, and I want to partner with you rather than given my execution to you. So that's where a RIA model would work.
Right.
And RA would only give you the research. They won't do your hand-holding or customization required for you. So you will need to have the market experience of 10-15 years to kind of just read the research and then do your own fund management and execution and do.
Understood.
Yeah.
Okay. So you're saying if I offer services of a RA, right? RA is a research analyst.
Right.
They will give me a list of stocks. Maybe they'll give me research that they've done.
Right.
But they wouldn't tell me where to invest, how much to invest. Right. I just get access to research.
Yeah. They won't tell you that how much percentage of your portfolio should go into which stock. Correct. They won't do your financial planning, your goal setting, your risk assessment. All this you will have to do it yourself. And in an RIA, all these things are done. Most of the RIAs would do this.
So if I go to RIA first will understand what is my pain point. Then they will customize a portfolio. Then they will give me an advice on this is how I should invest.
Right.
Can that advice also include which stocks to invest in and what allocation?
Yes.
It can.
Yeah. So there's a Chinese wall, so as to say, between research and advice. So to give unbiased advice, what is done in RIA model is you are given recommendation ki you should say buy X stock because of this thesis, which works with your risk profile. But it is not so execution is with you. So it's more.
So execution means buying and selling. I have to handle it myself.
Yes.
Got it.
So what the good part about it is, say you already have some mutual funds on some stocks which you have accumulated or your family has accumulated through generations. So you get an unbiased advice from RIA saying ki, oh, you should keep this for so and so reason and you should maybe liquidate this for so and so reason. So you don't have to give 50 lakhs outrightly cash to someone else to manage it and then pay even performance based fees, wherein RIA by regulation are only allowed to charge management fees.
Understood.
No performance based fees.
Right. So a client can come, maybe pay a flat fee, and then they get their entire financial requirement sorted through a benefit of advice of an RIA. That's the model, right? Okay, great. Jeet, can you give us a little background on where you worked, what you've done? Because I think last time we had a conversation, you told us you were working in Axis
Capital,
Capital and Equity Research earlier, right? Can you take us through your whole career trajectory, including education?
So I think let me go as back, say high school. My
how old are you, by the way?
I'm 31. Recently turned 31. My father is a tax practitioner. So, but he is lawyer by degree, and since 1992 he's been investing in the stock market. So for me, when I was in high school, I used to see him put on CNBC. He used to be reading, listening to people on the then maybe taking portfolio decisions for ourselves. And so it is his passion which kind of got me excited about ki this is also a stream which one can work in. So from high school, I used to ask him, dinner table conversations used to be about, oh, Mariko is doing the rights issue. So I was kind of asking him very basic questions in that sense. And throughout, I did my bachelor's afterwards. I did my BCom from Garware College in Pune.
So you're from Pune itself?
Yeah, I'm born and brought up in Pune. And at that time, during vacations, I used to go to the office, learn from him. So he did investing only for ourselves. So it was not like a business line or anything. It is more friends and family advice given for no remuneration. It was more, it is his passion. So he was just helping out people, because after taxation, most people would come and say, where do I keep my investments? What do I do with them? So he used to give them options, tell them this looks good. You should maybe invest here. And it was tax beneficial also, that kind of thing. Post this, I worked as a sub-broker for 2 years. And what this helped me was, I did the basic thing. So I understood what a pain point is.
You worked with a sub-broker or you were a sub-broker?
No, I was a sub-broker. So I did
almost
the NISM
entrepreneurial jump in a way.
Right.
This was right after your graduation?
Right after my graduation. So during my graduation time, I was doing this NISM exams. I was clearing things. I was reading all the material available, books and so on. And then I decided, let's do the plunge into sub-brokership, because that was like the step one. So I start getting accounts, I start,
This was in which year?
This was right after my graduation, so must be between 2014, around that time.
So we didn't have Zerodha then?
Yeah.
So I'm guessing broking business was lucrative.
Yeah. So
what were the commissions, do you remember?
So roughly I think 0.5%, like 30 paisa to 40 paisa was what was come to the sub-broker. So the main broker used to probably charge you 50 paisa, and then on top 50 paisa for 100 rupees transaction, and then we got some commission out of it.
So if I do a 1 crore trade, my broking used to be 50,000 those days.
Yeah, true.
Okay.
And then we got that brokerage, and from initially my thinking was, I don't want to earn a commission income, I want to give value added services, right? Like in terms of, I want the client to earn first, and then I would take a piece of it, not during doing more and more transactions. So I was one of the lowest probably. So because we didn't do a lot of trading activities, we did mostly long-term investing only. So my clients used to rather call me up and say, Jeet, what should I do today? And I'm like, we don't act today. There's nothing to do. You have a portfolio which is built, and we just build it for the long term. During these 2 years, I realized my knowledge gap is still there, because fund management, exposure to all the sectors, all that is not covered as a sub-broker or in the basic NISM exams which are required. So then I decided to pursue my MBA, but particularly from Flame.
Right. But at that moment, because I remember you told me you did MBA finance in Flame, which is quite popular in the equity investing world, right?
Right.
But at that point, did you not think of, I'm just thinking, were you aware of CFA? Did you consider that as an option at that moment?
I did consider CFA as an option, but you have to understand, So CFA, just the degree won't directly open doors for me at that time, was one thing which I had considered. And second thing was, I wanted to work at the intersection of finance and entrepreneurship. Because I was an entrepreneur myself, right? So I didn't want to give up the part wherein my options are closed, because I didn't know where I would land in. Would I land in research? Would I land in investment banking? Or would I get into some role of an entrepreneurship and finance crossroads again?
Understood.
So with MBA, my options were more. I didn't have to decide that, oh, I'm doing CFA only, though I wanted to work in capital markets throughout. So that was the
you had that clarity of thought.
That clarity was already achieved. I didn't know where I would exactly land for sure.
Right.
So if you are sure that you're going to land in working in capital markets.
Generally, people are not though, right?
Right.
I mean, generally, someone who's thinking of pursuing education, there is at least some doubt in their head, because even within finance, we have so many roles.
Right.
So how was the experience in Flame? I've heard it's an expensive MBA.
The ROI won't, say, if you consider two colleges in, say, Mumbai, right, NMIMS, you would think the ROI initially is a little bit less.
How much did it cost that time, if you don't mind sharing?
So I'm a scholarship student in Flame. So I got in on a scholarship based on my scores. So after the first year, I was the top of the class. So I got a scholarship in the second year, which, but roughly, say, Flame MBA fees for 2 years, including your living cost and laundry and each and everything, would be somewhere around 14 lakhs then.
14 lakhs
now
for 2
years.
years.
For 2 years. And they take care of each and everything. So the campus is one of the best infrastructure things you would see anywhere. You would have, the classrooms will be most well equipped.
I've seen the campus is beautiful, right? It looks like a resort there.
Most people mistook it for a resort, but the quality of education is great.
That's what I wanted to ask. How is the finance education there? Was it?
So just imagine I have Rakesh Jhunjhunwala sir coming into the campus talking to the students, his partner coming in and talking to us. Durgesh sir continuously kind of interacting with students who are like us in the very initial stages also. Even undergraduates or MBA students, they were talking to us directly, helping us figure things out, telling us what we should develop. You will have Kuntal Shah sir coming and talking to us, interacting with us, giving us, so Flame has a Flame Investment Lab, a different, it's a club as well as a
different entity of sorts.
Which would host lectures, which it does for professionals as well as beginners also. And I had the fortune of attending Sanjay Bakshi's course. I was selected for that. So they push for equities and investing within finance domain. This MBA is very different from what you would get anywhere else. So it's a platform they have created. You have access to Bloomberg, you have access to Reuters, and these professionals are coming and talking to you. The gap between knowledge and practical application is reduced.
Understood.
So I get an investment manager who is, say, running a fund of, couple of 100 crores, coming and answering my questions about, how should I look at a particular sector? How should I look at particular company?
So 2 years, you had a good learning.
Great learning. So
after that, what was the next move? You went to. Did you get a job on the campus?
Yeah, on the campus, a couple of us, based on our merit and criteria the companies had, were selected, and I got into Axis Capital. Fantastic learning experience.
So Axis Capital, were you on the sell side or buy side?
Sell side.
Sell side.
Yeah.
What sectors were you focused on?
So media, logistics, and then chemicals also.
Media, logistics. This was for how many years? 2 years?
Yeah, or a little bit more than 2 years.
2 years. Okay.
So here what helps is the rigor of.
Can you? Sorry, I'm cutting you in between. Can you give us an insight on how does sell side, like what is the difference between a sell side research and buy side?
Right.
From a career perspective, like how does an analyst think differently on sell side versus on the buy side?
Okay. So a sell side research is aiding a buy side institutional client mostly. So they would say Axis Capital would be some fund of theirs, or the fund manager there, or the fund management team there who is on the buy side. So buy side would be when you are not just recommending or providing research, you are yourself telling that, oh, in this fund we will buy say 3% of X stock, whatever.
So buy side is where the money is.
Yeah.
Where people are buying and selling. Sell side is the one who's providing research to buy side to take the decisions easily, right?
True. So typically how a sell side would work is you will be assigned certain sectors, not more than 2 sectors. Largely people, once they work in for 5 years in that one particular sector, they stick to that 1 or 2 sectors. Or say if you're doing auto, you do auto and auto ancillary, that's it.
For the rest of your life?
So probably where you take your career is, after what we have seen is say 5-7 years into sell side, you would ideally kind of start thinking about moving to buy side, and then you would start working for a fund. Once you work for that, you would want to become a fund manager. That would be the ultimate aim.
Right.
Like the career trajectory would look like that.
Understood.
Yeah.
So someone who's starting, so let's assume someone who's probably 21-year-old listening to us today.
Right.
They're thinking of careers in equity research. How is the sell side versus buy side career different?
Right.
And where do you think one should start? Should someone start on the sell side first and then go to buy side, or remain on the sell side? What's your view on that?
I won't give you a either or answer, because it is not either or. Like, both have its merits and demerits. On the sell side, what happens, the rigor of and the depth of research is huge. You have to understand the sector in too much, like the depth is very, very, very high, which ऐसा नहीं है कि on the buy side it is not there, but buy side you are largely sector agnostic. You are more focusing on the decision and the risk management side of things, as well as finding companies which follow the mandate which you have been given or you have communicated to the clients. On sell side, you have to understand the sector depth. You have to map out the sector, what is happening where. You have to understand each and every number in depth, and you should be able to communicate that also to the buy side guys. So usually
so sell side is much more in depth, whereas buy side is more big picture. Is that the way to think?
No. Okay, what I would say is, as a beginner, sell side would let you map out sector, let you understand each and every accounting thing and how does it work, and help you kind of start about how should one think when you are on the buy side. Buy side, usually first getting as a fresher a foot in the door is difficult.
Okay.
Number one, because you have no experience. How are you going to kind of decide that, I would invest, say typically a fund might be say 100 crores fund, and I would put 3 crores into X security. You have no performance track record. So how would you even convince yourself and then your clients that what you are doing is the right decision?
Correct.
Right. So you have very less performance track record is less, and because of that, getting as a fresher into buy side might have its challenges.
So typical trajectory you would recommend is get on the sell side maybe initially.
Yeah, so it is even lucrative, and you will have to create that knowledge base also when you are on the
What do you mean by
side.
lucrative? I've heard sell side pays are better than buy side. Is it true?
In the initial stages, yes. So on the buy side, you would have because you are charging performance based fees, there might be the fund manager. And
so you have good years and bad years on buy side.
Typically, yes, but you're depending on the size of the fund, because if the size of the fund is good, like large enough, then your just management fees will take care of, and your bonus on a good year will be, that big jump would be there.
Understood.
What I would say is getting a foot in the door is what you should focus upon. It is a hard thing to get into this career, because by default, 6 people, Giverny Capital is one of the funds which I like. Francis Roca, he is a fund manager, and they are, I think, a team of 6-10 people managing a multi-billion dollar fund. So you don't require because
a lot of people
knowledge leverage
increase,
is there. So just even if I have to manage 1 crore today or 100 crore, I don't need a lot of manpower addition.
Correct.
Yeah. So that's why the margins in this business keep on rising as your AUM grows. So first, get an internship would be the easiest way. So learn the skills necessary, because after reading books or doing courses, there is only so much you would learn. Correct. So internship might be the easiest way to get your foot in the door. Their focus.
By the way, Jeet has been recruiting a lot of interns from FinTree.
Right.
Some of them in equity research as well. So thank you for that.
Yeah. So the quality of students which we have access to via a FinTree like platform is something which we always look for. So
thank you.
That's a great learning.
So coming back to sell side, so you worked in Axis Capital for 2 years.
Two and more, I think a little bit more than 2 years.
Can you give a general flavor of, you don't have to be specific, general flavor of what are entry level salaries? Because that's the most common question we get on YouTube, right? Can you give us a flavor on what are entry level salaries?
My numbers are going to be a little rusty because I don't know what is the industry standard there. But typically, it's an entry level research analyst in any sell side, not particular to Axis Capital, would be paid between 8 to 12 lakhs when you have done it from a good institute, from an MBA college, or they recruit CAs and CFAs also. So it's not like here, because it's a place where you are competing with the best of best. You have to have a differentiating point. So what I tell students usually is, create a research report by yourself and try and understand the sector which you are familiar with. So if your father happens to work in a pharmaceutical industry, you are in a place like Hyderabad, or you're in a place like Bangalore, you're going to understand tech a little bit easily. You have at least people you can talk to about it. So map that sector out, create a thesis, and take that thesis and just go to knock on doors and tell them what you are thinking. And when a student comes to us or any kind of, we don't look for, we are checking their logical thinking ability. We are checking their, do they understand the curriculum, the basic financial concepts well, and has he or she done the work which is necessary to understand this sector. And additionally, we look at financial numeracy also. So these are the things which would easily differentiate you from the other guys who are there.
Understood.
Right. So
salary point apne bataya. Entry you said 8 to 12 lakhs.
8 to 12 lakhs, rough, give or take.
And which are the best sell side firms in the country to work? I've heard foreign institutional sell is generally looked at more positively than domestic broking sell side houses.
Right. Now you have to decide, do you want to work for the foreign markets or the Indian market?
No, I mean like guys like CLSA, but doing research on India.
Right.
In the value chain, I've seen they're perceived a little better than maybe someone like Angel on the sell side. Okay.
So the place you should choose when you are doing research in beginning, or mostly anywhere where you have to do, is how much learning you can get out of it. Because the initial 1 or 2 lakhs difference is not going to matter immediately. What is going to matter is what learning you get from there.
True.
Yeah. Obviously, if you are scrunched, you are taking out student loans and you're working, then go for the highest ROI. That is nothing, that's the normal. But when you focus on learning,
No, I didn't mean pay wise. Sorry, I'm cutting in between. I mean quality of research wise. Is it that certain broking houses, certain sell side houses are considered superior than the others? Is that a perception in the market or not necessary?
Okay, so you have to see whom you are working for, because it is very sector specific and analyst specific. So it's a industry where it starts getting human specific, person specific very quickly.
Right? Yeah, tell me more about this. I've heard about this. Does it become like this that let's say pharma industry है तो किसी बंदे का नाम बन जाता है,
right?
And then wherever that guy moves, everyone wants to get a piece of his research. Is that true?
Yeah. So you have rankings given by the buy side, largely mutual fund buy side, who will give a rank to an analyst. And if you
rank to an analyst, is it like an official published number?
Yeah. Asia Money. When I was there, Asia Money was the standard. I don't know now, has it changed or that's the same. So during that, they were given rankings, and on based of that rankings, if you are a star rated analyst, you started getting more people wanted to talk to you. And how do you become a star rated analyst is you go in depth about the sector, you understand where the opportunities lie, and you publish research, a differentiated research on those companies. So it is a very level playing field. So I might be in any brokerage house or any sell side research, and I have access to everything, right? So I should be able to
produce extraordinary research.
Research.
So which means it doesn't matter what brand of sell side house I'm working with, maybe बहुत basic होगा, but if my quality of research is exceptional, then I will get better ratings.
See, do client access matters? So if you don't have big mutual fund houses on your panel then it might be a little difficult to kind of be differentiated. So ideally what I would simply suggest is to go to places which have people who have been doing research for the longest period of time.
Understood.
And one way to check that is their investment banking divisions also usually do very well.
Okay.
Right. So because investment banking it's a relationship based thing. They have connects. So because they have to come up with an IPO and eventually kind of get it towards mutual funds or funds will buy into it.
So someone who has a good IB business generally will also have a good
research
sell-side research business as well.
Right.
Okay, very interesting.
Yeah. And
so coming back to you, sorry. I kept on cutting you, but you said 2 years you worked on access.
तो वहाँ पे rigor सीख लिया. Great access to management. Great access to, like say Manish Chokhani sir used to come and talk. Like I used to attend that. I remember seeing Monish Pabrai at one of the events which we attended.
Very
so
nice.
Lots of even industry visits would happen as you start getting more senior.
Do sell-side people travel a lot? Do they have to go to
there's lots of meetings.
Meets?
So a typical day would look like you get down to the office. If it's not the result season, you start reading annual reports and quarterly about a company you have been tracking. You go visit the premises, the manufacturing sector.
Is it easy to get access to management if you're on a good sell side?
Yes.
Typically, so you reach out to investor relationship guys and they will give you access.
They will give you access, and then you start building up your go talk to the industry people also. So you do your scuttlebutt in that sense, and then build up your view. Once you build up your view, you initiate a report on it, and then you track it. So the tracking, because I am catering to a buy side, is very rigorous. So the turnaround time for a report once a quarterly and a conference call is done might be something like 5 to 6 hours. And
what?
Yeah,
really?
And people would burn the midnight oil.
I didn't know that. So
it will be very
I think I have to update my model, write a report within 5 to 6 hours of earning call coming out.
Yeah, because
that's intense.
Tomorrow morning someone has to take a decision. If the quarterly call is like something big has happened, they have to take a buy or sell decision based on what one of the inputs is going to be your research. So you have to be.
So which means I'm guessing it must be a very hectic schedule during the
during the result season, during the earning season, very hectic schedule. But I think in initial years that's a great learning curve also. Because of that you learn about multiple sector, multiple companies, and you can't half-ass it. You have to know things what you are talking about and be very precise on it.
Okay.
Even to the last digit.
Got it. Yeah. So then you move to Pune.
Right.
To Money Works for me directly after that.
So I take the plunge from sell side to start my own advisory kind of a setup.
Okay.
Because I'm like, so obviously Access Capital, great platform. I got promoted also. So that was working out for me. But I decided if I want to take some element of risk and start my own fund management business, the earlier the better, because in case I don't succeed at it, I will have the time gap that I go back either to
probably get a job or something.
Yeah, or just find out an alternate. So that risk appetite was always there. Maybe I'm in I've been fortunate to be in a family which kind of gave me that cushion that you should go.
How old were you that time?
I was 26. Roughly,
so at 26 you 27. Set up your second business. Your first was broking.
Right.
Second was advisory.
Business.
How do you get the confidence to manage money when you're 26-year-old? I mean, because I don't think I still feel confident that I can advise on other people's money.
So, okay, first is I bought my first stock, so as to speak, or did my first equity investment when I was 16. Right, and by this time, because I've been in the industry, my father has been working, at least been around it, right? Like it is though not. So I know how things happen. Like obviously, when you start, I started small. I made sure the book is not someone's entire net worth, because a mistake could cost someone's fortune.
Yeah.
So I took not only risk capital, so I took money which was, okay, let me circle back a little. How do you create a book which is long term, right? So you have to take people who are thinking long term. Second, who have that risk appetite, who are not giving you their entire net worth, but giving you that portion wherein if a initial stage mistake happens, because you are also learning, it shouldn't hurt that person
them significantly.
And you have skin in the game.
Excess money that they have.
And you have skin in the game, because then if you put in your money, you are going to be directly like, I have never recommended thing which I have not bought into. My hard-earned money or my family's money into it, then I want to be like, the best fund managers are who have significant exposure to their own fund. It is like there's no conflict of interest. I do what is best for me, I do what is best for them, and it works out for all
Very
of us.
Interesting.
So I started with that book. I grew that book 2x in a very shorter time period, and realized that because I was doing the client meetings, I was doing the research, I was meeting the managements, and I was managing all of that by a single or a 2% team, it is not scalable. And then I by chance find out that Money Works for Me is looking for someone, and via reference I have a conversation with one of the consultants who used to work for Money Works for Me. And he recommends me there to come here, and I found that it's a very different place. So they have a big library which most offices wouldn't have, and I've been an avid reader. And it was founded with the initial idea, as I mentioned in the beginning, of retail investors or HNI investors don't have a fiduciary kind of a advice or institutional quality research accessible to everyone. So then I like the team there. I like the way they have been working with clients. So most of the clients have been with Money Works for Me for more than 5, some of them for even a decade. And it's a technology enabled. So all the technology is in-house. So we partner, we have say a doctor in Chennai, and we have a person who is working for a Fortune 500 company in Dubai, and both, because it's a tech enabled partnership platform, we are able to serve both the clients, and it is working out for us.
Sure. Yeah. So there's no geographical limitation anymore with tech.
Yeah.
So Jeet, what's your since now you're advising on a very large book, and I'm guessing a lot of that book is also customized to clients' requirement. What is your investment framework? Can you give us thought process on how do you look at stocks, and maybe if you can also give us 2 or 3 stocks, with which fit in your framework, and you can add your disclaimers as well.
Yeah. So we are a quality at reasonable price framework which we follow. It sounds simplistic that you should buy quality and you should buy it at a reasonable price, so it would make money, right? But what happens is, to follow it to the T, is first you have to establish what is quality in that sector, and we have multiple sectors, right? It is not a market which is 4 or 5 stocks is where the bulk of the investment is going. We have a diversified, we typically would have 20 to 25 stocks in a portfolio, and quality is looked by ROC is one of the frameworks which students can start immediately applying to check what is quality within that particular sector.
So what kind of number of ROC gives you an indication that it's a good quality?
So see, above your cost of capital, right? So it is because in a sector which is a commodity sector, if you are making more than your cost of capital, it is a good ROC. Typically one would say more than 15 is good, but why follow a thumb rule when you can find what is the cost of capital in that sector. And more than that, if a company is doing, then that company is doing better. Then you have to find out why is it doing better. So it might be a low cost advantage.
So for quality, you find your starting point is maybe to look at ROC metrics.
Yeah, one of the things which we look at is So
can you define, so quality is basically what? Like when I say, because it looks like right? Perfect, I'm buying quality, so what am I actually buying?
So first, to go and read my blog. So we will have a lot of material there. But there's this book by Zen and the Art of Motorcycle Maintenance, which talks about quality. So in that book, he has mentioned that quality is something you can you know this is a quality table, but you can't define it. So it because it doesn't have a standard definition. So within that sector, you have to see what quality means, right? So if easily you can in fabric, it is easy to say, oh, this is good quality because it is softer, more long lasting, feels good, and oh, this is maybe there's too much mixture. They have put in some plastic element into it, and it's not good. It will make me feel sweaty all the time, so it won't work for me. So this way you have to understand that sector in depth first, and then you can establish quality within that sector.
Interesting. So it's not stock first approach. You basically get into sector, and then you look at people who have some sort of a competitive advantage within the sector vis-a-vis peers. That's the thought process.
So we do bottom up as well as top down here, meeting in the middle. So I would look at, say, an opportunity. Oh, if logistics sector is growing very fastly, there is a government push to it. So we would kind of start looking at which are the companies within the logistics sector. Once we establish a quality in this sector, means these are the parameters one should look for, then we would start doing bottom up research about that company in depth.
Interesting. So give me an example. Let's say maybe logistics, for example. What do you think is a quality, and why do you think this forget valuation at the moment,
right?
Or whichever industry you want to pick.
Right. Okay. In logistics, it is a commoditized business because anyone. So we start with Porter's 5 forces basic framework. So first, is this sector something you should look for? Is what you should establish given the current circumstances or where this sector is going towards. In terms of so logistics, if you see the government push in that sense, they want to lower the logistics cost in India. China has logistics cost which is way lower than what is currently there in India. You can look at it as a percentage of GDP also. So we found that yes, logistics cost in China is cheaper, and that would give a push to the entire industry and the economy. So India should focus on lowering the logistics cost. Now, once we found that, oh, okay, this sector is interesting, there's an opportunity which could be found out within this, then we start looking at companies by, say, let's take an example, and this is not investment advice, but let's start looking at the express logistics segment. So in India, express logistics will be Blue Dart would fall into it.
Express matlab jaldi de
quickly. So you want your passport, your credit card, or you want to send some official documents to your friend, and you have to send it overnight, or you want to send it within a couple of hours. Or the Amazon parcel which you want to get from Delhi, because they have already told you that they will deliver within 2 days, they have to send it via
express.
Now, express logistics within air segment, Blue Dart would have a lion's share of it. They have 6 planes right now, and if you see their cost of capital versus ROCs, their ROCs are higher because their margins are higher.
Do they have their own planes?
Yeah, they own their 6 planes currently.
Okay.
And so it sounds a business wherein there's less competition because there are express logistics within the air segment, very less players. Right? Framework right for my mandate which is given to me.
Which is a client mandate.
Which client mandate. So we have our communication, we are a long-term investor. We do equities only, and we don't use any risk management from future and options. There's no, it is only long equity kind of a thing. And so then we found out, okay, this makes sense. Now then we check reasonability. How do you check, is it reasonable or not? You can
on the valuation
front. You can simply do a DCF or a peer analysis thing. So I look at financial modeling as a tool. It's not the only tool. Many people or students in the initial phases would kind of think valuation is one of the things. It is probably the last thing we would look at. So first establish quality, and the investment advice, our clients or me personally may or may not have investments in this. So this is one example. After quality at reasonable price, what we do, one more thing is we follow ABC of portfolio building, wherein you need core stocks which are, say, given, we will check if the client is conservative or aggressive and what their particular needs are. So then we'll fix up a core stock percentage. core stocks are which are consistent compounders. The quality is already established, and obviously they are available at reasonable price.
So core stock you look at relatively safer segment within your asset
More
allocation.
than so they we call them resilient companies who are able to weather a storm easily. So say a biggest bank in that sense would have competitive advantage which a short term fluctuation wouldn't easily erode. So
Understood.
that moat is intact.
Understood.
And we have seen in history that moat has been, or moat or even that competitive advantage has been tested and be shown resilience.
So your core portfolio is roughly of how many stocks?
So say
These are quality at reasonable price.
Price
Is
framework
that about
or-
15-20 stocks?
Yeah, so out of say 25 stocks, typically it would be at least 60 or 70% stocks would be there. Depends on now client to client because we do customization.
Right.
There.
So A is basically determining.
No, so ABC mein it's amplifier, boosters and core. So
Okay.
core is the bottom of the pyramid, the largest chunk which would help you that in a correction phase or when the economy is going through a bad turn, these core stocks will be like a great building block to your and you wouldn't have to sell off or liquidate your portfolio just because there is a short term volatility either in the prices or in the economy. So by that we are elongating our term which we will stay invested in. So that
Understood.
is the core.
So C is core.
Yeah.
B was
is
what?
booster.
Booster.
So Raymond himself started calling them boosters.
Raymond is one of the
founders.
Founder. Okay.
So boosters would help you get a better ROI, but they have their establishment, like their resilience is, so they are in a niche, they might be a dominant player, right? So your say Maruti Suzuki in auto wouldn't fall in the booster category, it will fall in the core category, right? So then a booster would be something which will help you boost your returns, and a risk which you are taking for it would make up for the returns which is there. So the ROI would make sense.
So Boost is a little riskier position than.
Typically a mid cap and a small cap,
Right.
so which again would have a competitive advantage and a reasonable price when we enter at it.
So you still have, so size changes, but the quality at reasonable price
doesn't
framework
change.
is still
That
there.
framework doesn't change.
And A would
And
be what?
amplifiers. So these are bets wherein the risk reward is the most favorable, but we would, because there is a risk element to it. So either because of uncertainty within that sector typically right now, or company specific corporate action happening, these would be amplifiers wherein we would kind of do things wherein the uncertainty element ki wajah se discount is there.
Understood.
Right?
Okay.
So the risk reward here typically will be much more than a core and a booster, obviously. But depending on client profile, we won't have more than 3-4 ideas within this amplifier for a particular.
So which means depending on the client risk profile, there would be some clients which will have 100% allocation to C. Some clients might have, let's say, a
60%,
60-40
yeah,
to
right.
C and B. And
Right.
some might have maybe 60-30-10 type of
Type of
allocation.
allocation.
Understood.
And then
Very
that is
interesting.
done with a partnership model with you. So if a client comes in, we don't outrightly say, oh, you are, you are 50 years old, you own your own house, you should have 50% allocation to equities, 50% to debt. No. We would understand your profile, we'll understand your goals, we'll understand what portfolio you have already built, and then kind of tell you, we recommend such kind of weightage for so and so reasons.
Understood.
And then every 3 months or at equal intervals, our advisory team will have a check with the client. Are we moving in the direction which the client wants us to?
Got it. Okay.
Yeah.
All right, Jeet, I think now we'll move to next segment.
Yeah.
Generally what we do is it's a AMA session. So we have a lot of people who keep on posting questions.
Right.
A lot of these are generally career-oriented questions. So we'll try and answer them together. Right now I'm just looking at questions from previous YouTube videos, right? Okay, so first question, RI and HNI we've already done. RI model is done. One question I have is, what are the key characteristics in equities that generate consistent long-term returns? So, बहुत
Right.
difficult है.
Okay.
What's your view? I think let me rephrase this maybe because this is a very vague question to answer. But what's your view on entry level earning multiples? Right? I mean, in my personal investing journey, I've gone through phases where I thought PE is important, and then I went through a phase where I thought a PE is stupid. Now I'm again in that phase in my investing journey where I feel PEs are super important because everyone understands them. So what's your view on getting into a fantastic quality business, maybe growing at a good rate, but entry level multiples are, let's say, 70, 80, 90. How do you deal with situations like those? Which is the story of Indian market today.
Right, yeah. So first, if you can run a DCF, you don't have to, then your question becomes, what is the terminal
growth rate?
What is the terminal growth rate and
or
hence,
multiple?
What is the terminal value? So in a DCF, typically, terminal value would be taking care of the bulk of the valuation.
True.
And so then a question for an analyst or an investor becomes, what is the terminal value of this business? And which will typically, you will get it very easily from how has been the terminal value perceived, because market, being Mr. Market, would give it any multiple. But if you have an established history of 10-15 years, it is easy to say, auto company shouldn't trade, or if it is trading at 50-60 multiple of PE, then that it's something different.
So terminal values in your model, are you doing them on comps or are you running your growth assumptions? How do you get your terminal values?
Both. So what we do, because it's a toolkit, right? Valuation at the end of the day is a toolkit which we are doing. So we would typically run it via a peer analysis framework, a comparative analysis, and we will do a DCF if possible also. And we are very particular about what growth rates are you building in for the terminal valuation.
True. But that's where I think things go wrong.
And see, what has worked for the longest period of time is that your entry multiples can't be something which is not justified. So say I will tell you a great example of they are in the travel tech industry. TBO Tech is the name of the firm.
TBO Tech,
So that's
I think we spoke about this last time.
It's a negative working capital business with great margins, EBITDA margins, and again great ROCs, return on capital investment. ROE is great, growing at a, I think 15-20% kind of a rate. So you have to rank business models wherein what is the best business model and what you will give to that particular multiple, what will you give that, and then you can come down from it.
नहीं, but दिक्कत क्या होता है ना कि जैसे let's assume now there are a lot of, let's take your financial ecosystem businesses, right? Your CAMS, CDSL, all of these. On an average, they're trading at a valuation of about 50
times,
in the ballpark, 50 times of their current earnings. Now, even if I decide to build a DCF model, I need terminal value 5 years down the line. What assumption do I make? Because historically, these businesses haven't traded at such higher valuation.
Right.
If I keep exit multiple at maybe 20-25, so मेरा जो earnings से benefit हो रहा है, वो multiple में चला जाता है. So by that logic, even great businesses but higher multiple looks unattractive to me at the moment.
True. We are with the same view. Say last about 6 months back, and not to toot my own horn, but most of our new clients who had come with us, we were typically about 50-60% on cash. And that is just done because we can't find anything at reasonable valuations. And as a long-term investor, I have no obligation like a fund to deploy capital immediately. So we are very upfront in that sense that we would tell 2-3 months, we will tell the client that, oh, right now no opportunities are there. We have gone through multiple sectors, multiple ideas, and because we don't have any opportunity, I think we should probably park it.
So which means a great quality, but if the price is not reasonable, or
we won't break the rule. So see, now you have to see that a business. So compounding equation is simple. Raymond in his book mentions that wealth is equal to your net worth. So you have to invest your net worth. It is not going to be your risk capital. So when we work with clients, it is not like they are giving us, say if they have a portfolio of 20 crore, they are giving us 1 crore. We are working with them on probably their most highest liquid net worth is parked with us. Multiplied by 1 plus research edge, which comes from the rate of return, will come from the research edge, raised to the behavioral edge, which is the term.
N.
So because you are going to be invested for long time, and you have, so like Warren Buffett says, I can let go of multiple opportunities because he has 12 stocks which made most of his net worth.
Very true.
Right. So I can have a place where, and because of this, you are going to miss out on certain opportunities. So we have been, say, our mistakes, and we want to highlight our mistakes also, because we do go wrong, though our hit ratio has been favorable. That's why we have, been able to survive this long and thrive. So we missed an opportunity like Zomato. We couldn't see it. We did the valuation. It didn't make sense for us, and we missed it. Outrightly, it's a mistake. But because of that, at the same time, we didn't invest in 5-10 other businesses, which according to us, when the valuation multiples were not attractive, and now we are getting them at attractive valuations.
Investing is anyways a career of regrets. I mean, you either create errors of commission or omission. I think for me, errors of omission are okay. I think I've let go of the whole crypto world. I never touched Bitcoins. I've in fact started studying seriously now. In the hindsight, if I look at this looks like an error of omission, right? Because probably it was a no-brainer 10 years ago to buy them. But I think that's how our careers are, right? We'll always have some of the other regrets in some ways.
And regrets are a great learning tools also. Because of regret, I have now position sizing discipline, which is built into it, wherein I can say, okay, we are making a portfolio of 25 stocks. It is diversified enough that my risk management will be there. And still now, let's not go into a particular opportunity at 1 or 2% only. Let's size it accordingly.
Very true.
So these regrets help you do your opportunity. Like thankfully, it's a place where because of your mistakes and learning, you keep on getting better.
So how do you do position sizing now? Do you have a function of conviction, or is it just equal allocation?
So largely, it would be a function of what the client requires. So if a conservative client is there, so I would like that core allocation would be diversified enough that it makes sense for him.
So 25 stock, 4% each type of allocation?
But then core, we have to increase the weightage. So then that would bring that some core might be a little bit on the higher side than a booster stock. So our risk management would work. And then there are some aggressive portfolios where it will be according to conviction, because I am seeing a gap in the market. It is typically a bet which is making sense from risk reward perspective, and there we will size it accordingly because the aggressive clientele is there and the mandate is like that.
Understood.
So it is very client specific in that sense.
Got it. All right, I'll take some more questions. I think we did this, but this is a question from Suman Laha and Tejas Deshpande both. They're asking, what skills does one need beyond financial modeling to enter into equity research? I think even in my class, if I do a poll, 70 to 80% people will say, "हमको equity research में, सबको equity research में काम करना है." So how does what should one learn?
Okay. First is curiosity. In terms of you can't not be curious about businesses. Okay. Curious
but
about.
But how do you build that? Because even मैं भी लोग ये बोलता हूँ, you need to be curious. Like buy some product, see who's manufacturing it, and do that.
Perfect.
But how do you build curiosity? As in, because some people might have it naturally, some people might not.
Not right. So you have to have a inclination to know how the world works. So I am not understanding. I am trying to. So curiosity takes you any place which right now you are the most curious about. As you are learning about cryptos right now, I am learning about, say, a sector which I want to get into it in deeper sense, and it is coming from a place of curiosity. Might be sometimes from an opportunity perspective.
Sure.
So how you keep on building is go down that rabbit holes during when you have the most time, which is typically when you are a student, and pursue things which may or may not directly make sense going ahead. So you can't devote all your time to activities which may not have a fixed outcome. right? I have to study for my CFA to get into the, like, get my qualification ready and get a foot in the door. But at the same time, I should say I can spend my weekend trying to pursue that one hobby, which may not be related to my career at all, but still is developing my curiosity. So one more way is reading books. So most of the investors you talk to would say that they are avid readers. In our job description also, literally we say we prefer people who are avid readers, because that's the way to show your curiosity the easiest way, right? We do on our blog, we do a lot of book reviews, and one of my colleagues, Yog, he's very good at writing these book reviews, and because it's a way of learning and synthesizing and then sharing.
True.
So curiosity, see, if you are at a place where you think you have zero curiosity, right? Just lock yourself in a room and no social media, no phone, hopefully no access to internet, and then see what comes up. And after that initial phase of discomfort for an hour or two, the third hour, you're going to think, oh, this is something I was probably as a child I liked doing, and I would want to maybe explore it more. So I've learned, like say TEDx is a platform I really like, because there I will meet people who are from different domains coming and sharing things which they are doing differently. So I have been a TEDx organizer, I've been a host there, and that is one of the platforms which you can go just for your curiosity, type in anything, TED.com, and go and search, say, architecture, and then see what people at the cutting edge of architecture are right now saying.
Very interesting. Yeah. So read books, be curious.
Yeah.
Learn how important is financial modeling.
Okay, it's a tool. It's one of the tools in your tool basket. It is largely necessary, and it gives you a structured way of thinking, right? Because
I think in order to model, you have to learn the business first.
Yeah.
So a lot of these precursors of understand business, industry, सब उसमें capture हो जाता है.
And go to an industry which is easier to understand. Na? Start with FMCG. You have the volume data. Nestle gives out their volume growth. They give you their value growth. You can go to the retail shop right now and buy a product, see how it looks, what is the packaging, does it taste. You can make out wo bik raha hai kya nahi easily, right? And then you can extrapolate from there and then tie it down to the numbers. Are the numbers going in the way which you are thinking? Are they establishing their distribution channel? If they have been growing last 5 years by 15% roughly till FY24, where has the growth come from? So understand a sector which either A, you are curious about, or you are in the vicinity of it to understand it easily.
Right.
Then go down deep in what is quality in that sector, where is the opportunity, what is happening, right? Understand the commentary, read the con calls. And right now, because of tech being so easily accessible, imagine 10-15 years back, you didn't have con calls which you could easily go from, say, screener.com and find out, or you couldn't go talk to a company. Right now, you can call up the IR and hope to get a meeting with them, or call up a smaller company within that same sector and try and see what the the domain expert of that company is speaking about what is happening, where the transition is going towards. So curiosity is number one. Numerical fluency I have mentioned. So you should be able to do quick math about, say, EBITDA margins going from 20% to 30%, revenue growth rate of 10%. How much will be the translation in PAT? So numerical fluency is one. Third is communication, because an analyst starts from communicating his notes, say a buy report, in a synchronized manner. You can't write a 30-page report and expect me to read it when I am getting 100 applications, right? You have to know that these are the 3-4 points which is the crux of the argument and present it in that manner. Then I can ask you, okay, I'm curious, how did you arrive at this assumption? Then give me the research or attach a link.
So ability to articulate and present data.
And communicate effectively. So you don't have to entertain me, but you have to be able to read this, say, everyone says buffet letters. They articulate it so well that you are able to easily get to the crux of the argument very quickly. So communication is something we'll look for. Then we'll look at how adaptable or is their thinking, which is, can they think from first principles? Can they take learnings from one sector and apply it in another sector. Because you don't have time enough, or you can't say that, oh, I will take 5 years to learn now this B sector from. You have to say what you learned in your mental models in sector A and then see if it works in this B sector also or not.
So I think a lot of, from an actionable perspective, a lot of skills can be developed if people just start reading more, right? Reading little diversified.
Yeah, and one more thing I will put on, not to go on for this long, is find your role models. There will be investors you are naturally kind of, you find them that, oh, this is the way I would like to work, or I'm more curious about him. So the earlier you find your role models, and they can be multiple also, it becomes kind of easier that you can, oh, okay, I think Peter Lynch is the way to go, right? So read all Peter Lynch A to Z, and then go to the next investor, and then find out where your style matches with the greats of the, and we have had, say, Flame has a great resource on their page wherein they have uploaded all the videos which have the Flame Investment Lab has put that on. You can go to, say, our blog.
Really? You have all the past session videos are available
for free
of cost?
Yes.
Really?
Yeah.
Oh, I didn't know that.
Even their YouTube channel has it. Then you can go to, say, our blog wherein we do a lot of book reviews. We do a lot of CFA Society talks. We have recorded the learnings from it in a manner which is simple enough to understand even to a retail investors. And then build on to your own framework, and don't stick to it in the initial phases. Over a period of time, from your experience, the best way to learn is by doing, right? So do it on your own capital at a smaller thing, see what works, and then keep on doing more of it
with time. Okay, sure. I think I'll take last couple of questions.
Right.
I think again one more question. There's a gentleman who says, I'm transitioning from military aviation to equity research. How do I get started? Apart from what you just spoke, do you have a special recommendation? Military aviation.
Okay, so
Yeah, very
military
cool.
aviation, you would have the great qualities on the behavioral finance side of how to manage risk. When you are, there is this book, Checklist Manifesto, which talks about how in airline aviation sector, they follow a checklist.
Everything is a checklist,
right?
yeah.
So you have a checklist approach which is drilled down to your brain. You are able to make decisions. So your behavioral finance edge is already there, and you will be very good in risk management. So try and extrapolate those kind of things which you already have learned to your investing framework, which will easily differentiate you from the 10 guys who are doing it. And if you see during World War II, a lot of research which happened and the industrialization have transformed into the corporate sector in America. So try and get those learnings of risk management, behavioral finance, which you already know, because fight or flight, right? You should know ki, say, your one company which you have been tracking is right now down 20-30%. Are you right now fearful, or are you should be greedy and get into it, like, start building up a position? Ye kisko, who would know that more? Aviation, military,
very true.
Would know that better.
So ability to keep calm in stressed environment would come to him naturally.
And that checklist approach, which is, I think Checklist Manifesto is one of the books which Monish Pabrai also talked about, and he has a section in that book which they have.
Do you mean the
recorded.
Michael Chern book? Which
the Checklist Manifesto. The book's name is only.
Yeah, I think it's called Investment Checklist, right? I've read a book on checklist.
No, this is written by a doctor. So there's two different books. One is the Checklist Manifesto, which talks about how you should use checklist, and one of the chapters is on Monish Pabrai, how he uses a checklist for his investment process. Yeah.
Okay. All right, Jeet, last question of the day. We're done, right, Aditya? Last question of the day. I think sometime back you mentioned you've yourself decided to write CFA level 1 exams.
Right.
And there's a candidate who's asking, I want to know why you chose to write CFA now, because you clearly don't need it. You've done enough, but you still thought maybe you wanted to write. There's a candidate who's saying, is CFA by itself sufficient to have a good career in India, or do I need to do something else?
Okay, I'll take the second question first. A qualification will only get you in the arena, right? It's a foot in the door. Because I don't know your thinking process, how you act, how you work, I am using this as a proxy to check what is your knowledge base. So it will get you in the arena. After that, you can't stop learning. It is something which so many people say, but very few people are able to keep on learning continuously. So being a learning machine, so that's why we have a library in our office. That's why we go and attend CFA society talks. That's why my analysts, we push them to do courses continuously online, to use say ChatGPT right now and experiment with it. Because as soon as you stop, you are limiting yourself, and you are like your edge which you have developed, you are letting go of that edge because my qualification is done, now I don't want to read. So we have one of the team members who worked with us earlier. He is a CA, CFA who has done both of this, and now is still pursuing higher level courses to keep himself updated on it. So learning doesn't stop. So CFA is good and a very good platform to get into the arena, as I said, but it is not sufficient. After 2 years, no one is going to ask you, oh, do you have a CFA degree or not? They are going to ask you, what is your portfolio? How does it look like? What is your risk management strategy? How many companies or industries you have studied? That's the conversation which is going to happen. So focus on the learning aspect more as soon as you are done with
but to answer question, so learning can be independent of what career I've chosen. It could be MBA, CFA, right, whatever. But by CFA by itself, if let's assume someone is learning,
definitely.
Do you think that's a good enough qualification in Indian markets?
We have people who have joined from FinTree who have interned with us, who are now full-time team members. So that transition itself shows you that CFA as a degree is working out, because it is working in the real world also. And as a course, the gap between practical and theory is very, very less. So I think it is enough.
It's a good enough course to start with.
And why I am doing it is that first though, in MBA we had I think 6 subjects a term. So in a term you did go to depth of that one particular subject, but by default I didn't get to spend 3-4 months learning a subject in depth, which I am right now able to kind of go in that read the core curriculum and understand it, the nuances of it. That is number one. So for me it is a great learning tool. And second is, it is mostly becoming an industry standard. So if you want to get into fund management roles, if you want to be a fund manager, you want to be a CIO, you want to move up the ranks in the industry, it is kind of becoming that you should have this as a core qualification. So it's one of the standards which is there. So, and you have coaches like him helping you through the journey, and I have had fantastic reviews about the way he teaches about CFA curriculum.
Thank
even
you very
to
much. Okay. We can plug in isko marketing ke liye use kar lenge.
So yeah, I think that's why I'm doing it. And
learning is your main focus. Okay, fantastic. All right, Jeet, it has been an interesting conversation. I think we should do this more often, because I think there were a lot of areas I couldn't touch on. I wanted to get a little more specific on your stock picking framework.
Right.
Maybe next time whenever we get a chance.
Yeah, let's do about it. And we can do a live case study, which could be more fun.
That will be very interesting actually.
Yeah.
But thank you very much for coming in.
Thank you for inviting me. And the Money Works for Me team is very happy with the way FinTree has been doing things with us.
Thank you very much for recruiting people from us.
Yes.
Actually. So there we go. This is the end of the session.
Yes.
All the questions that we couldn't answer this time around, because I could not do live YouTube questions today, I'll try and do them next Saturday in the same session. So you can post these questions in the comments of this video once it gets live, and then we'll try and answer them. So with this, thank you very much. See you all next week.